Good afternoon, everybody. Welcome to the first event in the Investment Academy series, and welcome, Howard.
Thank you, Max.
We're thrilled you could join us for our opening event, which, as Stacey said, is designed to help investment managers develop their investment skills and drive great decision making as well, which are subjects clearly close to your heart. I know that you share Warren Buffett and Charlie Munger's thoughts on the concept of perpetual learning. And indeed, you've written, given, I'm quoting now, given the non-specific nature of investing, there's no such thing as being finished with your learning, and no individual has a monopoly on insight. And a bit later on, I want to come on and talk to you about risk and cycles and your latest book, of course, and of course, investor behaviour too. But I'd like to begin with your career. Can you give us some insight into the early days, your early days as an investor, and the lessons that you learned then, which was important today, as they were when you learned?
Sure. Well, my first job in the investment business was 1968. I joined Citibank as a summer employee between years of graduate school. And I started in the investment research department, and then when I got out of grad school, I returned there and spent a total of 10 years in equities. And, as we were discussing outside just before, 50 or 40 years ago, the world was a pretty stupid place compared to today. Just about everybody is smarter than they used to be, or at least they have access to more information, which is different from intelligence. But I can think back to several examples of, I would say, the naivete of the investment world at that time. For example, if somebody would say to us in those days, well, what kind of return do you think you can produce in your equity portfolio? We would say 12. They'd say, how do you get that? Well, you say, well, stocks produce around 10, so if you try a little, should be easy to be about 20% above average. That, obviously, the events of the last 50 years have shown that it's not so easy, and that in particular, sheer effort in the investment business does not tend to produce results. It's not a matter of perspiration and elbow grease. Another good example. Tell me when you want me to stop.
No, keep going.
I'll go on.
I've got lots of questions, but
well, then you're not going to get to many if I go on. But
I will stop you now.
But the greatest single example, which is still important today, is when I arrived. The bank was an investor in what was called the Nifty 50, and the Nifty 50 were the 50 best and fastest growing companies in America, and they were considered companies which were so great that nothing could ever go wrong. And further, they were so great that there was no such thing as paying a price too high. So you didn't really have to worry about valuation, because if the price was a little high, they grew so fast, wait a couple of years, the earnings would grow into the price. And as a consequence, some of these stocks sold incredibly at 80 and 90 times earnings. Well, number one, it turned out that some of them were companies where something could go wrong. And, the Nifty 50 included, when we look back, Xerox, IBM, which both had brushes with death, Kodak and Polaroid, whose businesses disappeared, AIG, which went bankrupt, my favorite, Simplicity Patterns, which was a stalwart of the institutional investment world. Raise your hand if you've made an article of clothing within the last 6 months. I mean, in those days, people used to make their own clothes, and everybody assumed that a company that made patterns could never have a problem. So, number one, it wasn't very forward-looking. And number two, it wasn't very valuation conscious. So if you joined Citibank the day I did in summer of '68, and if you held those stocks diligently for 5 years, you lost almost all your money in the best companies in America. And it wasn't unusual to lose 80 or 90% of your money. So then, that didn't work out very well. And by 77, the bank brought in a new chief investment officer who brought in a new regime, which was not growth stocks. And I got lucky. I wasn't fired. I was asked to switch to the bond department to start a convertible bond fund, which was a backwater that very few people knew anything about. And so I was ecstatic and just trying to get know a few securities better than everybody else, and try to make a little money with a small amount of capital under management. And then that summer, in August of '78, I got the phone call that changed my life. And the head of the bond department said, there's a guy out in California named Milken or something, and he deals in something called high-yield bonds, and can you figure out what that means? So I started a high-yield bond portfolio in late '78, and now I'm investing in the worst public companies in America, and I'm making money safely and steadily. So this was an incredible lesson. You lost money in the best companies in America. You made money safely and steadily in the worst companies in America. So what's the lesson? Number one, that good investing does not consist of buying good things. It consists of buying things well. It's an enormous lesson. Number two, that most of the success of what you do will be determined by the price you pay. And anybody who says that's a good idea or a bad idea without inquiring first about the price is really off the beam. And if you, in those days, of course, we didn't have computers, and if you reached down from your desk onto the shelf, if you could, and you pulled down what was called Moody's Manual, which was a book about this thick on onion skin paper, so really thin paper, but the book was this thick nevertheless, and it had the information on every bond in one book. And if you looked and it
like
said...
Like your Bloomberg terminal there.
Yes, right. But if you looked and you said, what is the definition of a B-rated bond? It said, fails to possess the characteristic of a desirable investment. And how can you say that if you don't know the price? That's essentially saying, for this bond, there's no price at which it's a good buy, which is as stupid as with the Nifty 50 saying, for this company, there's no such thing as a price which is excessive. And that just shows you the error of those times. Now, fast forward, 1978, Michael Milken kind of invents the high-yield bond world. The premise was that, and prior to Milken and to that moment of 77, 78, low-rated bonds, speculative grade bonds, bonds below BBB, could not be issued because Moody said they lacked the characteristics of a desirable investment. You could not issue a double B, single B, triple C bond, period. Milken's creation was the realization that even if a company is of low quality, there must be some rate of interest which is sufficient to compensate for that risk. And high-yield bond, speculative bond issuance began in 77, 78, and of course, it's a big deal now. High-yield bonds are $1.3 trillion in the U.S., and leveraged loans are probably $1.5 trillion or something like that. And more importantly, though, so what was the underlying principle? The sufficiency of the anticipated return to compensate for the anticipated risk. And if you think about it, that's what the world runs on today, our world. Everything is about the adequacy of return to compensate for the risk. Nobody says, that's so good we can invest in it regardless of price. Nobody says, that's so bad you can't invest in it regardless of return. It's all risk return. And so that was the moment really that changed the world.
So I guess very much in the early days, high yield bond market was what you described as being inefficient. It wasn't well defined, it wasn't well known, and there were people who said that you just simply can't invest in it regardless of price.
Yeah. And more, 90% of investment organizations had a rule against investing in less than A or less than investment grade. Rule.
So one of the things that I'd like to then perhaps rewind a little bit to is your time at university school in Chicago, where you went after being at Wharton, and you were in, if not the first class, one of the first classes to really kind of be taught what's become known as Chicago School. So this was what we now define as the basics of, it was efficient market hypothesis, modern portfolio theory, the concepts of alpha and beta. How useful was that to be at the vanguard of learning about those things, and how has your view of those things over time, your acceptance of them, evolved?
Well, I think that it was an incredible gift to be there at that time. We were talking before about, I asked Max which of my memos he liked the best, and he said one that I wrote in January of 14 called "Getting Lucky," and I think it is. It's the one that got the most response, although maybe not until the last memo. But it was a very important one, and I consider luck extremely important. I consider myself to have been incredibly lucky in my life, and in a memo, I think the reason people liked it is because I listed a dozen ways in which I felt that I had been very lucky. And going to Chicago, and being at the beginning of any positive trend is a great gift. You can't claim credit for doing it. It's a historical accident, but it's an incredible thing, and that was for me. So, for example, look, the efficient market hypothesis, which says that all available information is already incorporated into the price of every security, so you can't do better. You can't beat the market. You can't tell which ones are there aren't any bargains. There aren't any overpricings. Everything is fairly priced. This is a cornerstone of the theory. I think it's essential to understand it. Now, if you believe it, you shouldn't be here, because it means there is no scope for active management. So, but if you don't understand it and consider it, then you're really missing something. It is real. It is important, and you shouldn't swallow it whole, but you also shouldn't ignore it.
There are different ways to interpret it, I guess, aren't there? And that markets may be efficient most of the time, but clearly, and this is one of the ways that Oaktree has performed so well, as you mentioned earlier, is that recognising the extremes of cycles and being able to act aggressively at that time when markets aren't efficient.
Again, if you go back to that memo, what we said about high yield bonds just now, they were not known, not understood, denigrated by the authorities, illegal in many applications, and they had a bad name for them, junk bonds, right? So how could they not language cheap? Now, and 40 years ago, people would say to me, well, young man, I'm sure you could make money doing that, but would it be right? Would it be respectable? And fast forward to 2019, now nobody gives a damn. Anybody will do anything they can think of to make money today. Nobody has any scruples. Well, yes, I could make money, but far be it from me to stoop that low. The world has changed. And so, there's nothing that's off bounds because of its own character. And there's very little that's unknown. Information is ubiquitous, computer literacy, etc. So what I say in the luck memo toward the end is that there is much less reason today to believe in the existence of what I would call structural inefficiency.
Yeah.
But from time to time there is cyclical inefficiency, which is to say that regardless of the merits of an investment, sometimes people like it too much and sometimes they like it too little. And those are forms of error, which you might say is inefficiency, and we should try to take advantage. So when they like it too much, we should sell it to them, and when they don't like it enough, we should buy it from them.
Yeah. So I want to come on to cycles because I think that's going to be a clear focal
Time to pitch the book
for us, and we will pitch the book. I'll hold it up in a second, but I do just want to, before we move on to that, just talk about your career a bit more, because the list of colleagues, mentors, people who have contributed kind words about your book is one of the great and the good of the investment industry. Could you talk a bit about your the people that have most influenced your career, be they mentors or colleagues or people in the wider industry that you have found their input very useful?
Sure. Well, a lot of people say to me, who was your mentor? And I never really had a mentor, per se. I mean, it was mostly reading and studying, starting at Chicago before I started work. But I did learn a lot by experience. One of my favorite sayings is experience is what you got when you didn't get what you wanted. And so, the experience of losing 90% in the growth stocks was very educational. And the experience of making money in the high yield bonds was very educational. John Kenneth Galbraith was one of my favorite inspirations. And he wrote a book that I read early on called The Short History of Financial Euphoria, which talked about cycles in euphoria, so the ups and downs of psyches, which are very important. And that book had some very, very important quotes, which I use all the time. One is that we have two kinds of forecasters, the ones who don't know and the ones who don't know they don't know, which I believe in very strongly. And then another is what he says about one of the dominant characteristics of financial markets being shortness of memory. And, people just always forget the lessons of the past, and that is what causes cyclical occurrences to repeat. If people understood and remembered and avoided their tendency to go to excess, then I think the cycles of the world would be much more muted, but they don't learn it.
Which is strange, because humans are relatively unique in being able to learn from our mistakes, yet when it comes to the extremities of cycles and financial matters, we seem not to be able to learn from mistakes.
Yeah. Well, I think frankly that on the one hand we have prudence and memory, and on the other hand we have envy and greed. And most of the time, greed wins.
Yeah.
Charlie Munger, who is one of my inspirations, always quotes the philosopher Demosthenes, who said, "For that which a man wishes, that he will believe." So most people, if you show them a scheme and you tell them it'll get them rich without much risk, they'll take it up.
So talking of Charlie Munger, he is a great promoter of the concept of mental models. So mental models being ways to force yourself to view situations through a different lens, or to be able to assess situations very quickly and make a decision quite quickly. Are there any mental models that you use? I mean, you talk about second level thinking a lot. Would you class that as a mental model?
Well, I think the second level thinking / variant perception / who doesn't know that together are a way of thinking. My son wanted to be in the investment business, so he went off to college, and he would come home and he should say, well, we should buy Ford stock because Ford is coming out with a great new Mustang. And my answer was always the same: who doesn't know that? The point is that the things that everybody knows are already in the stock price. So if you know something and you say, oh, that's going to make the stock go up, you should think about whether everybody else knows it and have already incorporated in the price. Second level thinking is similar. What second level thinking says is that if you think the same as everybody else, you'll behave the same. And if you behave the same as everybody else, you'll have the same performance. The goal is to outperform. So thinking and behaving the same as everybody else cannot be the route to success. Rather, you have to think differently. You have to see things differently. You have to perceive some information differently, or interpret it differently, or analyze it differently. And only if you do that can you rise above average performance. Now, you can't think differently just for the sake of being different. You know, if most people say, well, it's probably going to be, the weather tomorrow is probably going to be about the same as today. You can't say, well, just a minute, if I'm going to be successful, I have to be different. So I'm going to say that I think that the weather tomorrow will be either 20 degrees hotter or 20 degrees colder. It's not a winning approach. You have to do it for good reason. But you have to think different, and you have to think better. So if you try to be different in your thinking, but it drives you to think worse, to more erroneous conclusions, that's not a way to success. Different and better. So an example is very simple. The first level thinker says, this is a great company, we should buy the stock. The second level thinker may say, it's a great company, but it's not as great as everybody thinks it is, we should sell the stock. That's an example of second level thinking at work.
So Daniel Kahneman wrote a very famous book called Thinking Fast and Slow, which is about intuitive thinking versus more analytical thinking. It's not to say that one is better or worse than the other. Would you describe yourself as a slow or a fast thinker?
I'm a fast thinker. I'm intuitive. I'm impatient. I hear a situation and I reach a conclusion. And by the way, and then I'm done with it. Now my partner, Bruce Karsh, who's been my partner for 32 years and co-founder of Oaktree, he's a slow thinker. So he'll listen to me, he'll say, I'll think about it. He'll go home that night, he'll come back the next day, he'll say, this is why I think you're wrong. Then we'll talk about it, we'll reach a conclusion. He'll say, okay, he'll come back the next day, he says, no, I thought it over, I don't think it's right. So the point is, we have a different approach. And that's, I think it's the combination of the two that makes us successful.
Yeah, they complement each other very well.
You know, I wrote, my first book was entitled The Most Important Thing, and it had 20 chapters, each one of which said the most important thing is, and then it's a different thing, starting with second level thinking. And one of the things, not in that book, but I had previously written a memo by that title, and one of the things that I think is the most important thing for the success of the team in business is what I call shared values and complementary skills. So Bruce and I absolutely share values. We're both conservative, we both emphasize risk control and consistency, and there are many, many ways in which we share values. But we have complementary skills. We're different people, and there's a tendency to A, associate with your own type, or B, disrespect people who think differently. And these are two formulas for disaster. It's much better if you can associate with people who bring skills different from yours and respect them enough to get the best out of both.
And you talked about, in the most important thing, having a toolkit to overcome psychological biases and the letting or not letting the emotional side of investing kick in. Could you expand a bit more? I think you touched on it a bit there by having teams with complementary skills, but it's more comprehensive.
Well, you know, I think that emotion or excesses of psychology are really public enemy number one in the investment world. Because what happens in the investment world? As things go well, as companies do better, as prices rise, people get more excited. And they want to buy more, albeit at high prices. And if that process goes on for a while, people become absolutely euphoric. They'll buy at any price, and that's how you get into bubbles. And I think that when people say, you know, this is a good buy at any price, I think that's a sign of a bubble. But then, and so if you think about it, as the price rises, most people buy more and more. And then eventually something goes bad and things start to do less well, and they switch from euphoria to depression, and the lower the price goes, the less they want to own the thing until it reaches a bottom at which nobody wants to own it at all. and all people can think of is getting out before they lose even more. And so it's the error of euphoria at the high and depression at the low that are the enemy. And rather than buy here and sell here, what we really want to do is buy here and sell here. Buy low, sell high. But everything in our being conspires to make us do the opposite. So I think it's important that, again, that we operate in teams, that the team members try to buck each other up and help each other avoid emotional excesses rather than contribute to them. Like one person says, you know, I bought it at 60, but now it's 30, and I think it's going to 10. Maybe I should get out. And saying to them, yeah, you're right. Go ahead and sell doesn't do them any favor. Rather than to say, let's think about it. Why did you buy it at 60? What has changed? Has anything fundamental changed, or only the price? Has it just been put on sale? And if it's on sale, rather than sell, should we buy more? You know, these are the things. I remember when we were in the global financial crisis, and it was the fourth quarter of '08, and I spent a lot of that. I think I spent the month of October here, which was, of course, the worst month of the crisis, October '08, and you know. We had raised, most of our distressed debt funds were $1, $2, $3 billion. And we had raised an $11 billion fund in case there was a crisis, and put it on the shelf. And so we had a lot of capital sitting there, and we Bruce and I reasoned it out, and we concluded that we should start investing. And I supported him. He did the analysis, and I supported him in saying, look, nobody else is willing to buy. The prices we're paying must be inordinately cheap. It's time to buy. And then the next day he would come in and he would say, I think we're going too fast. And I would say, well, I understand, but look at the values. And then the next day he'd come in, I think we're going too slow. And I'd say, you know, don't get crazy. So I think it's, you know, the point is you can provide complementary, supportive skills to your teammates, and not just an echo chamber reinforcing error.
So let's just dwell on the 2008 experience, because that was remarkable, actually, what Oaktree did. So Lehman had just collapsed. You had $10 or $11 billion on the shelf ready to deploy, and you did deploy it at the rate of $500 million a week for 15 weeks.
Right.
And you wasn't immediately looking like you were right, because markets were still falling. Right. So that was a difficult period, and I think you even perhaps had to go back to co-investors to convince them that you should continue, perhaps raise more money. Right. Did you ever have a crisis of confidence and think that perhaps you weren't getting it right? What was the mindset at that time?
Well, Max, I don't remember having a crisis of confidence. Of course, if you buy and then the price goes down and you buy more and the price goes down further, if you're not questioning and a little scared, then you're a moron. But you know, I think that one of the important things that I have realized and incorporated into my thinking is that you're never going to get it exactly right. Sometimes, if we're lucky, we know what's going to happen. We never know when. And so if you accept that, then it kind of gets you off the hook. That means you buy today at 9, it goes to 8. You buy more. You buy at 8, it goes to 7. You buy more. You don't say, oh my God, I bought at 9 and it went to 8. I must be a moron and I must be wrong. You understand that the nature of this. And, you know, Warren Buffett says, I like hamburgers, and when hamburgers go on sale, I eat more hamburgers. So, you know, if you did an analysis at 9, and if the analysis was sound and it goes to 8, you should buy more. Now, of course, in our business, there's always the question of when does resolve turn into hubris, and there's no easy answer. But it always goes back to rechecking your analysis, and ultimately to your analysis being correct. Which, of course, it's your analysis. You always think it's correct, but you have to be very vigilant, and you have to believe that it's correct for good reason. But I wrote a memo. You probably, since you know them all, I wrote one in, I think it was February of 16, called "What Does the Market Know?" And see, what happened is in 16, the market got off to its worst start in history, and it was really collapsing, all markets. And so I wrote a memo called "On the Couch," because I said that every once in a while the market needs a trip to the shrink, and that it was really the victim of irrational fear. So I went on Bloomberg the next day. Usually when I put out a memo, I go on Bloomberg the next morning, and the hosts kept peppering me and saying, well, stocks are collapsing. Isn't that a sell signal? Isn't that a sell signal? So I went back to my office and I wrote a memo that day called "What Does the Market Know?" And this is really a very important concept. The market is supposed to be efficient, know everything. We know it doesn't know everything. And I believe there are times when it doesn't know anything. So I said you can't let falling prices be a sell signal, because falling prices are the equivalent of investments being put on sale. How can they be a sell signal? If anything, they're a buy signal, etc. So I went through this whole business on that subject. And then I said, and you know what? However, when we, bought high-yield bonds in 1990 when they were collapsing, and when we sold into the tech bubble in 99, and when we bought in the period you're describing, etc. I never want to give anybody the impression that we don't do it with trepidation. You can have, if you have great advantages, you can have a strong intellect, and you can act on the basis of your intellectual analysis, and you can control your emotion. But that doesn't make you right. And there's always the possibility that you're wrong, and we must bear that in mind. And so, and since we're only human, when we do these things, when we buy in October '08, it terrifies us. But if you think about it, buying at the low point has to terrify you.
I guess there's a sense of, and I think you've said this, that having raised the money, seeing the valuations that you saw, it was a case of if not now, then when.
Yeah.
And
Yeah.
that galvanized you.
Well, look, a couple days Lehman went bankrupt on the 15th, and as I recall, I put out a memo on something like the 18th or 19th entitled "What Now?" Or maybe it was "Now What?" But what I said in there. By the way, believe me, if you weren't there, it was impossible to figure out what was going to happen. It was impossible to prove that the financial system of the world either would or would not collapse. In general, we can't prove anything about the system in the future, and that's particularly true when we're going through an event that's never occurred before. So there was nothing intelligent to say about the future of the financial system at that time. So what made us buy? Well, number one, objectively speaking, the things we were buying were extremely low prices. We were buying the senior debt of companies that had been the subject of LBOs 1 or 2 years earlier. And we were buying the senior-most debt at prices where if the companies turned out to be worth a third or a quarter or a fifth of what these great buyout firms had paid a year earlier, we would have broken even. And we figured out, well, and you know who I'm talking about, but we said, well, sometimes, like when you go to buy a car and you negotiate with the car salesman, you know, you say, well, yeah, I probably could have gotten another 5% off, right? Do you negotiate car prices in this country? Okay, good. So sometimes you come away and you say, I probably could have gotten another 5% off. But did you ever say, well, I probably paid too high by a factor of 4? You know, I bought that car for $60,000. If I'd only negotiated a little, I probably could have paid 15. You know, so similarly, we concluded that the great private equity firms who had done all that due diligence probably did not overpay by a factor of 3, 4, or 5. Yeah. But then the other thing is, we reached the conclusion that what I wrote is, if we buy today and the financial system falls apart, doesn't matter what we did. But if we don't buy and the financial system doesn't fall apart, then we didn't do our job. So we should buy. And that's about as profound as it got.
So that experience was incredible for those that worked through it, very painful at the time, but actually was incredibly powerful and useful as a lesson to be learned for later careers. And I do want to quote, because I want to move on to a subject now that we chatted about before, but I want to quote from your book first. And you wrote this about your experiences, I think, in the early 70s. While I had a lot more to learn, I already knew a bit about fluctuations in psychology and risk attitudes and about their importance. But I had almost no appreciation for the role or operation of the credit cycle. In short, it's hard to fully understand most phenomena in the investment world unless you've lived through them.
Right.
So this is the longest, if not the longest, possibly the second longest expansion in history.
Right.
It's 10 years since the crisis.
Yeah.
There's a whole generation of investors working in the city, working in New York, around the world, who have not seen a bear market. What's the risk associated with that, and what advice do you have for somebody who is working now but didn't have the benefit of that experience?
That's a good question, Max. There are 2 chapters in the book, of which I think everybody should buy several copies. And the 2 chapters go together. And in fact, when I sat down to write the book, I had an outline of what I would write, and I'd write a chapter on the economy, and one on profits, and one on psychology, etc. But I ended up writing a chapter, and it's one of the longest and I think by far most important chapters in the book, which is the cycle and attitudes towards risk. Because we are supposed to be objective, rational weighing machines who always figure out what the risk is and buy when we're well compensated. But in fact, sometimes people get euphoric and embrace risk as their friend and a source of income, and sometimes they get terrified and flee from risk as just a source of pain. And so the attitudes towards risk are very volatile and fluctuating. Then the next chapter is the cycle in credit, in the credit market, the credit market cycle. And the 2 play together. And most people, Max read that passage, most people are not aware of the importance of the credit market cycle. But it is really, really influential. And it starts really with the fact that most people don't think about enough, which is that nobody pays their debts. Governments never pay off their debts. You think that the UK government will ever in the future have a day when it owes less money than it owes today? I know the US government will not. Most companies never reduce their debt, and most individuals don't reduce their debt. They just put it on the credit card, and then they pay the minimum payment to get through, but they owe more money every month. Nobody pays their debts. They rely on the ability to roll their debts over. So you know, the U.S. government issues some 5-year notes. The 5 years pass. They assume that when they mature, they'll be able to go back to the credit window and say, I'd like to borrow that money for another 5 years. And the credit person behind the credit window will say, that's fine. And that's the way it usually goes. But what happens if a company has some bonds, the bonds are outstanding, the bonds mature, they go to the credit window, they say, we'd like to borrow that money, roll it over for 10 years, and the credit window's closed that day. What if it's a day of panic? What if it's a day when people are so terrified of risk that they will not renew the debts? Then that debtor is bankrupt. So the availability of credit, the openness of the credit window determines life or death for borrowers. And its openness is dependent on the mindset of providers of capital with regard to risk on that day. And it's extremely important. And you know, one of our outstanding businesses at Oaktree is called distressed debt investing. And basically there have been 3 times we started that in '88, so we're now in our 31st year. There have been 3 times that we had exceptional opportunities to buy distressed debt at very low prices because other people were panicked and refusing credit. 90-91, the first crisis in high yield bonds. 01-02, when we had the telecoms meltdown that had overborrowed to build fiber, and the scandal companies of Enron and so forth, and then 08, the global financial crisis.
Yeah.
You know, I wrote a memo in September called The 7 Worst Words in the World.
Yeah.
And what are the 7 worst words in the world for an investor? Too much money chasing too few deals. When there's too much money chasing too few deals, the prices get bid up so that the prospective returns are low and the risk is high, and you want to know that. And again, that's a function of attitudes towards risk, availability of capital.
So you describe cycles as being chain reactions, that the length or the amplitude of the cycle is a function of what's happened before.
Right.
What do you think the seeds are that are being sown now in this current cycle that will have an impact in the future?
Well, I'm much better at predicting the past than the future. But let's talk about, you know, and one of the things I say, I don't believe in forecasts, and like Galbraith said, and one of the things that I say is we never know where we're going, but we sure as hell ought to know where we are. So where are we? We're in the second half of the 10th year of an economic recovery. And there's never been a recovery in the United States that went more than 10 years. So based on the data, we're coming to the end. Now, the process doesn't work like clockwork. The fact that there's never been a recovery of more than 10 years doesn't mean there never will be. And there's every chance that this will go on beyond 10 years.
It's been a long recovery, but a slow one.
Well, and that's the other thing. It has been the slowest recovery since World War II. So why is that important? And the answer is, well, I was writing this book called Mastering the Market Cycles, an indispensable resource. You know, I believe in cycles. I think cycles are one of the most important things for us to study. And I believe that they have, you know, I've lived through about a half a dozen really important cycles in my career, and they have given me a lot of opportunity to make money. They've given other people a lot of opportunity to lose money. So I believe there always have been. I believe there always will be. I believe they're very important. And I believe that they are understandable cycles. But as I got about 2/3 of the way through the book, I had a revelation. I said, why are there cycles? U.S. economy grows on average about 2% a year right now. Why doesn't it always grow 2%? Why sometimes 3 and sometimes 1, sometimes 4 and sometimes negative, sometimes recession? Why not just 2 every year? Stock market, your S&P return, you mentioned earlier, returns about 10% on average. But not only does it not return 10 every year, but it rarely returns between 8 and 12. So the norm is the average is not the norm.
Yeah.
Why? Why do we have mostly above average years and below average years rather than average years all the time? And the answer, in my opinion, is excesses and corrections. So people get excited, they commit errors of emotion, and so if something has a U.S. economy has a 2% underlying trend line, they get excited, they make decisions to invest and to purchase and to produce and to hire, which causes it to grow more than 2 for a little while, but then it turns out that everybody made decisions that were too positive, and that has to be corrected, and so they stop investing and they stop producing and they stop hiring, and then you have a below average year, excess and correction. So I think that when you think about cycles, rather than think about ups and downs, I think it's much more helpful to think about excesses and corrections.
So I've got one more question before we open up to the audience for questions, which is about the popularity of, if emotion and excesses are why cycles happen and why markets can be volatile, to what degree does non-human trading, algorithmically driven trading, i.e. non-emotionally driven trading, impact the market today, and what do you think it might mean for cycles in the future?
Well, it's a very deep question, not easily answered. Clearly, computers don't have emotions, so they should not make emotional errors. On the other hand, computers have to be programmed. Computers, eventually, some decades out, there'll be something called machine learning, through which computers will study all the data of the stock market over the last 100 years, every price, every day, every investor's portfolio and return, and eventually they'll probably figure out what produced gains and what produced losses, and they'll probably be able to give themselves their own remit. But not yet. So right now they have to be programmed, and they have to be instructed what to do. I believe, I'm not an expert, I believe that most computers are programmed to believe that the things that produced profits in the past will continue to produce profits in the future, which you might call trend following or momentum. And, for example, stocks that go up are more likely to continue to going up than to go down. Maybe small cap stocks are likely to outperform big cap stocks.
Yeah.
And low quality stocks are likely to outperform high quality stocks. These are value judgments that can be programmed in, that the things that happened in the past will continue to happen in the future. Well, that's true, and it always works until it doesn't. And at some point, you can program for, let's just take low quality, small stocks versus large. So small cap beats large cap. But by definition, it can't go on forever. Because if the small stocks appreciate faster than the big stocks long enough, then they go from being cheap relative to the big stocks to being overpriced relative to the big stocks, and by definition they shouldn't continue to go on. And so betting on the small stocks to beat the big stocks at some point in time is probably going to become a losing strategy, but we don't know when.
It's a cycle itself, isn't it?
Well, that's right.
Value
That's right.
growth or small versus large.
That's right. But it can go on for a long time. And lots of people have lost a lot of money and careers by betting that the things that have been going on will stop. Of course, other people have lost careers betting that the things that have been going on will continue.
Yeah.
So there's no easy answer. And if you look around, there aren't a lot of people who've gotten fabulously wealthy doing algorithmic investing. There are some. And, Three Sigma is said to do a very good job. They're a little secretive. Nobody knows exactly their results. Renaissance Technologies is supposed to have the best results and produce returns in the 20, 30, 40% range. But not a lot. My mother used to say it's the exception that proves the rule. I never knew what the hell she was talking about. But I think what it means is that the rule is that algorithmic investing doesn't work, that Renaissance and Three Sigma are the exception, but their exceptionality proves that the rule is mostly right. I think that's what that means.
And human perception can be very different
Right.
from reality.
Right. So, you asked me before about mentors, and I mentioned John Kenneth Galbraith, and he said there is nothing intelligent to be learned about making money, because if there were, study would be intense, and everybody with a positive IQ would be rich.
Yeah.
So, in general, there is no methodology that can be depended on to work all the time and forever. And one of the things I try to tell people, and I even wrote it down when I had this thought, and I wrote it down and I still carry it around, is you should give up on finding a method that will always work, and instead you should try to find a thought process that will work most of the time.
Makes complete sense. We've got about 20, maybe 14 minutes for some
Great.
questions.
Great. All right, who has the best question?
So, please.
Yes, Jimmy.
Thank you very much. What are the key indicators that you look for, that you track to help you give you a picture of where we are in a market cycle?
Well, look, we all read the economic data and the profit data, and we all try to tease out the significance, and the problem there is that everybody sees the data and they pretty much see it the same, so there's not too much advantage in that, I don't think. What I try to do to get an advantage, as described in the book, is to understand where we stand in the cycle of attitudes. And I use a process that I call taking the temperature of the market to help us understand where we stand. And but it's not like I have a list of 5 indicators and I look at those and they always tell me the answer, because our business and the investment and financial and economic world is so dynamic that the things that matter always change, and that's the thing that makes investing challenging and interesting. Anybody here read the book Fooled by Randomness? Not too many. Well, some should. It's a very interesting book written by Nassim Nicholas Taleb, who later wrote The Black Swan, that became more famous. But he talks about investing as being beset by randomness, and he says as a consequence, past histories really can't be relied on too much, because past histories were created largely by randomness rather than some mechanical action. And he constantly is comparing investors to dentists. Because in dentistry, he says, there's no randomness. You fill a tooth the same, you always get the same result. In investing, there is nothing that always works. And, yesterday's solution may be tomorrow's failure. Well, that's what makes it challenging and interesting, in my opinion. So you can never have the same indicators, but you should think about the type of indicators you're looking for. An example. That memo I wrote in September, 7 worst words in the world, talk about private credit funds, direct lending funds. And I said that in between, I think it was 08 and 13, there were 80 new private lending funds, of which 20 were first-time funds. And between 13 and 18, there were 320 new private lending funds, of which 80 were first-time funds. Well, I believe that the ability of managers to raise money for first-time funds is a great indicator of the temperature of the market. Somebody comes in here, he stands up on this stage, he says, I've never done it before, but I'd love to give it a try with your money. And when people are naive and euphoric and unconcerned about risk, they rush the stage to give him money. What does that tell you? What does that tell you about the environment? It tells me that it's a time for caution. So the ability to easily raise first-time funds, I think, is a problem. By the way, there was an account last week of a fund, a direct lending fund, that had, I think, 25% of its capital in one name, and that name went bad. Wow. And I think that the fund has been suspended and the CEO has gone. And that organization started in 2012. So, and it was a first-time fund.
I guess this is the abundance of capital is one of the seeds that's being sown for the future.
Exactly. Too much money chasing too few deals. And if so-and-so, who's a great credited investor, is raising a fund, but he's full, and you want to put some money to work, and you can't find anybody like him, well, then you give it to somebody who's never done it before and let him take a shot. But it doesn't sound like a good idea to me. No. So that's just an indicator. Who else?
Darren.
Hi Howard. The question of one of the big quandaries of our time. So prior to the financial crisis, we've gone through 30 or 40 years where we had high real growth rates, high inflation rates, high interest rates. And since over the last 10 years, the features have been low interest rates because we've had low inflation and low real growth rates. So putting your forecasting hat on, which you don't like to have, is the next 10 years going to be more of the same that we've had over the last 10 years, or are we going to normalise at last?
Well, I have a definite answer, which is I don't know. But, look, this is very hard. I think most of the time, the future is somewhat like the past. So, and I say in the book that the four most dangerous words in the world are, it's different this time. And so I would think that eventually we will continue to have growth, and we will get some inflation, and interest rates will work their way higher. And we were going that way for a couple of years until the shakeup in the fourth quarter, and now the Fed has backed down on raising rates and tightening liquidity, and it looks like Europe will follow. And the rate on the U.S. 10-year has gone from, the crisis really started on October 4th when the rate on the 10-year got to 325, and now it's like 238. So, by the way, so this is really important but unanswerable, is the answer. And I was having dinner with Warren Buffett about 3 years ago, and he said to me something very interesting. I think I might have mentioned this in the book. For a piece of information to be desirable, that is a prediction in this case, on this an answer to your question. It has to satisfy two criteria. It has to be important, and it has to be knowable. And I think the answer to your question is extremely important, but absolutely unknowable. So, if it's really unknowable, then spending a lot of your time trying to figure it out is probably a waste of time, and betting on your conclusions would probably be a waste of money. It's really, nobody knows, and these topics are mysterious, and inflation is especially mysterious, because I don't think anybody really knows what starts it, or, and I lived through the 70s when we didn't know what stops it. Many countries, such as Japan, have wanted to have inflation for the last 30 years. In their case, they can't get it. In the 70s, we didn't want inflation, and we couldn't get rid of it. So I think that inflation is really mysterious, and something called animal spirits make such a contribution to the growth rate of an economy, and they are just emotional and thus hard to predict, that I don't think anybody can tell you how fast we're going to grow. We know that technology and automation have in some ways, and increased productivity, have in some ways taken a bite out of certainly inflation and maybe growth, but we don't know how much. So this is why I don't spend a lot of time, and I never, one of the tenets of Oaktree's investment philosophy is that we never invest on the basis of macro forecasts, because they're important but unlikely to be right.
Tom?
You mentioned most of the time greed wins. That's to do with the shape of the cycle, and the fact that sell-offs tend to last a lot less time than bull market territory. Is that, can we pin that on prospect theory and greed being more powerful than, fear being more powerful than greed rather? And is that inherent in cycles going forward?
I don't know. Tell me about prospect theory.
The prospect theory is a loss is more painful than a gain of the same order of magnitude.
I just think that what's present in the human psyche most of the time is greed and aspiration. And so the positive, and by the way, most cycles, be it the economy or the market or corporate profits, have a positive underlying trend. So you have a positive trend, you have fluctuations around the trend, but for most of the time, the economy's growing, companies are more profitable, markets are going up. And those three things combined with greed tend to cause bull markets to go on a long time and eventually reach excesses. Then it seems that what happens is that people believe they're going to make money. They invest on that basis. As the market grinds higher, they put still more money to work because their greed has been rewarded and reinforced. And eventually, everybody gets all their money into the market. Just then, something goes wrong, and the fear takes over, and it just seems, for one reason or another, that maybe it's disillusionment. Maybe it's the fact that all these things that everybody believed and had working for them and felt that they understood, and now they have to say, damn it, I guess I didn't know what the hell I was doing. And that disillusionment, I think, is a very strong force and works with the fear of losing more to make people panic and sell in a big hurry. And as my partner Sheldon Stone always says, the air goes out of the balloon much faster than it went in. It just seems to be. So, yes, we do seem to say markets go like this and this and this, and there's long ups, fast downs. I don't know what you're going to do with that information, but if you figure it out, let me know.
We've got time for one more. Joe.
With regards to negative yielding debt, do you think that will over time change people's perceptions of risk and reward and how they actually interact with markets and lending?
Well, that's a great question, and that's even further beyond my ken. I mean, I some time ago I bought a house in Spain, and on a Thursday I freed up the money, and I wired it to my Spanish lawyer, and the closing was going to be on Monday. So he calls me on Friday. He says, "I got the money. What do you want me to do with it?" I said, "Put it in the bank." He says, "But by Monday you'll have less." I said, "Okay, don't put it in the bank." He says, "You have to put it in the bank." So again, I find negative interest rates incredibly mysterious, and we don't have them in the States, of course. We haven't had them, and Europe seems to have had them and to have adjusted to it. And you read last week and this week that that institutional investors in Germany have concluded that they'd rather have the certainty that in a short time they'll only have a little less than they have today. I don't know where that comes from. I don't know how you deal with it. I don't know if there's any way to say whether we'll ever get it or not. I will say that when I was walking around in October '08 thinking about the financial crisis, by the way, going into the financial crisis, all the money I had in the world that wasn't at Oaktree was in 1, 2, 3, 4, 5, 6 year treasuries, which is called the laddered portfolio. It's the dumbest form of investing known to man. And I was terribly happy because I always had some liquidity, and I was getting about 6.5% with no risk. Liquidity, no risk, 6.5%. And then I was walking around thinking about the crisis, and of course, and so when the nearest maturity rolls off, you get a call from the broker, and you buy the 6 year again, and it goes to the back of the line. So you always have 1, 2, 3, 4, 5, 6. So the broker calls me up. He says that 6.5 matures on Thursday, and you can roll it over at 5/8. I said, "What in 5/8?" He says, "No, just 5/8." And so I was thinking about that, and it struck me that I was making a riskless investment, and I was being paid 6.5% to store my money. And isn't that usury? And what if people reach the conclusion that they would actually pay to store their money safely? Well, that's what negative interest rates are. So I guess it makes some sense, but most people, given that opportunity, would probably look for an alternative. And there are alternatives, but of course the alternatives force the money out the risk curve, which is kind of like what the authorities wanted to accomplish 12 years ago, and they did successfully. And maybe it'll happen again today, but the idea of sitting and settling for a slowly melting ice cube is not too appealing, certainly not to Americans.
Howard, thank you. We're
Thank you,
we're
Max.
immensely grateful.
Well, I'm sorry I
for
couldn't
your
answer
time.
every question.
No, that's fine.
Great.
Ladies and gentlemen, Howard, Mark.
Thank you.